This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This chapter goes through and looks at IFRS 5. Now, the important thing to understand about IFRS 5 is that it is clearly separated out into two distinct sections. The first section that we're going to go through and look at here is looking at your non-current assets held for sale, or if you like, your disposal groups held for sale. Now, that is whereby you have non-current assets. So let's just say property, plant and equipment, and you have made a decision that you are going to sell that non-current asset. The issue here is how do you go through and treat that non-current asset on the face of the statement of financial position? Because if you're looking to sell it, you're going to be selling it in less than a year, and therefore it is now no longer a non-current asset, is it? So we need to look at the accounting treatment to reclassify it from non-current down to a current asset, where it will be referred to as a non-current asset held for sale, okay, within current assets. The second aspect focuses more upon the profit or loss side of things and looks at your discontinued operations. That doesn't necessarily mean that discontinued operations solely focuses on profit or loss, but it's more relevant to profit or loss, because if you have decided to go through there and close down one of your main business operations, that means therefore that within the following year or two, you will no longer be operating in that same line of business. So therefore, you're going to have to split out your results, so your revenues, your costs, and your profit, into the profits that you're going to generate from your continuing activity, so what will carry on for the foreseeable future, and what you will have generated from your discontinued operations, because it's important for the users of the accounts to see the discontinued operations profits or losses, revenues, and costs, because they are not going to recur again into the future, are they? So it's all about essentially splitting out your revenues, your costs, and your profit to do with your discontinued operations. But we'll look at that in the following video. This video, to start off with, is looking at your non-current assets held for sale. Okay. So, as we said, the key bit about your non-current assets held for sale is that you have made a decision to sell an asset. That's the key thing. You're not just abandoning it or scrapping it. You are disposing of it. You're going to sell it. So you're going to receive cash for it. So in order to be able to go through and reclassify it down to non-current assets held for sale from your non-current assets within PPE, it needs to be available for immediate sale. So you can sell it just like that there aren't any processes or major adjustments that need to be made to the asset to be able to sell it, or you're not intending to keep on using it up until the date of sale, okay, because maybe you need to fulfill some orders. It can be sold, okay, in its current condition, and likewise as well, that sale must be highly probable. Okay, so again, going back, if you like, to the criteria and the framework, things need to be probable, more likely than not. And what IFRS 5 does there is it just gives you additional information about when it does become highly probable. If you like, to give the auditors a little bit more assistance. For that to happen, we need to sell it in less than 1 year. Okay, so 1 year from today's date. If not, it will be classified still as a non-current asset. Likewise, you must have started actively to go through there and locate a buyer. Okay, and also that you must be actively marketing it. Okay, so if you haven't approached anybody, you haven't put out adverts there to go through and identify that this particular asset is a non-current asset held for sale, then it cannot be classified as a non-current asset held for sale. It has to be demonstrated that it can be sold in its current condition, and it is more likely than not it is going to happen. Okay, if that's the case, you can go through there and reclassify it, okay, to that non-current asset held for sale. The key issue there is that you're going to remove this asset from the non-current asset at its carrying value. So what do we then put it at as in your non-current assets held for sale? Well, there are rules. Okay, there are rules, and it comes to the world of prudence, because what we're going to do there is we're going to put it in at the lower of its carrying value and fair value less cost to sell. So if we know that we're going to sell it for more than what it is currently worth within our financial statement, so if we expect to sell it for more than its carrying value, we do not anticipate that profit, do we? It's not prudent to recognize profits until they've actually happened. So if that's the case, we're just going to transfer it down from non-current assets in PPE down to a non-current asset held for sale at its carrying value. But if we think we're going to sell it ultimately at a loss, then what we're going to do there is, i.e. its fair value less cost to sell is below its carrying value, well, it's prudent to recognize that loss, essentially the impairment in the value of the asset, immediately, isn't it? So therefore, we take it out of PPE at the carrying value. We put it in at its now lower amount, being the fair value less cost to sell, and any difference is recognized there as an impairment through profit or loss. Okay, so it's an accounting example of the application of prudence, okay, which we said isn't specifically mentioned within the framework, but it is assumed that that is one of the processes that we go through and account for. Prudence as an accounting concept. Okay, so what we've gone through and done there, essentially, it is looked at IFRS 5 under the cost model. Okay, so if your property, plant and equipment is held under the cost model, you can reclassify it to a non-current asset held for sale at the lower of the carrying value and fair value less cost to sell. Okay, provided that it is ready for immediate sale and it is highly probable that it will be sold. Okay, the other alternative, the other option that you have is, just be careful, is that if your property, plant and equipment is measured under the revaluation model, so likely to be maybe land and buildings, then what you go through and do there is that you revalue it to fair value before you go through then and classify it as held for sale. Okay, so if it's under the revaluation model, you revalue it and get it all correct first before you then go through and do the classification. Okay, so treat it as normal. Any gains go to other comprehensive income. Okay, you may then think, well, what's happening then when I do my reclassification? Well, you're going to reclassify it at the lower of its carrying value and fair value less cost to sell. Well, just think about that. The carrying value is now the fair value, isn't it? Because that's what we've just revalued it to. So that carrying value at fair value is always going to be greater than the fair value less cost to sell, isn't it? Because you're deducting the selling costs from that fair value. So when you reclassify it, it was going to be reclassified as a fair value less cost to sell, and therefore the selling costs will be expensed immediately, won't they? Okay, because that is the difference between the fair value and the fair value less cost to sell. It's just a really small, tiny, picky point that you may pick up upon. If not, don't worry. Okay. Key bit, however, is that once you've reclassified it as a non-current asset held for sale, you stop depreciating it, so you stop treating it as a non-current asset. And then when you go through and subsequently sell it, possibly in another accounting period, you will just generate a profit or loss on disposal as normal. You take your proceeds, compare that to the value of the non-current asset held for sale. Okay, and that gain or loss on disposal goes to profit or loss. Okay. There we go. So they're the rules. Okay, let's just go through there and piece it together with an example. So let's have a look at the example. The example goes through there and asks us to explain how the above transaction should be dealt with in the financial statement. So statement of financial position, statement of profit or loss and other comprehensive income. And is it there for the year ended the 31st of December 2015? Okay. So what have we got? It says at the 1st of January 2015, Namibia carried a property in its statement of financial position at its revalued amount. So we must adopt the revaluation model on this item of PPE. And it was there currently, was it at 14 million? That's the start of this accounting year. Depreciation is charged at 300,000 per year. So if nothing happens within this question, we just depreciate it for the full year at 300,000. But I have a sneaking suspicion that things may move us towards IFRS 5 as we work it through. In April 2015, the management decided to sell the property. So if you have made a decision to sell the property, that makes you think about IFRS 5, doesn't it? Okay, is it a non-current asset held for sale? Well, it says it was advertised for sale. So that looks like we are actively marketing it and looking to locate a buyer. By the end of April 2015, the sale was considered highly probable. So we're going to be selling it in less than a year as well. It's in its condition available for sale, so it can be sold immediately. And the criteria for IFRS 5 non-current assets held for sale and discontinued operations were met at this date. So at the end of April, so is that January, February, March, April, 4 months into the year, the asset is now no longer measured under IAS 16 PPE, but will now be measured under IFRS 5 non-current assets held for sale. Key bit, remember we said though, however, it was held under the revaluation model. So before we think about IFRS 5, we need to revalue that property. So there's likely to be a gain on that property, and any gains under IAS 16 and revaluation go to OCI. Don't forget as well that we need to depreciate that property as well, because we're now at the end of April. And we only had the value of the property at the start of the year, didn't we? So we need to depreciate it for 4 months. The fair value of the asset that we will revalue it up to is 15.4 million. So we can get everything right under IAS 16, and then under IFRS 5 we need to value it at the lower of its carrying value and fair value less cost to sell. So cost to sell, we're told there, are at 300,000, aren't they? Okay. On the 31st of January 2016, so that's next year, okay, there might be a gain or loss on disposal as we get the proceeds of 15.6 million, but don't need to worry about it for 2015, do we? Okay. The transactions regarding the property are deemed to be material. No entries have been made in the financial statements regarding the property since the 31st of December, is it 2014? So we need to process all of the adjustments. So what you've got there is we will need to look at the statement of financial position. We will also need to look at the statement of profit or loss and other comprehensive income. So that will be split into profit or loss and OCI. Okay. And then in the statement of financial position under our current assets, we will have a non-current asset held for sale, won't we? Okay. So what we're going to have to do is we're going to have to do a working to work it all through. So head up a page of paper that is there, it has your workings. And what we're going to go through and do there, as we've got an asset under the revaluation model, we're going to put in our standard pro forma, aren't we, for our revaluation. So that's 4 columns. You have the narrative column, the historic cost, the revaluation, and is it the surplus column. Okay. So what we had was it at the 1st of January 2015, the asset was valued, was it, at $14 million. So a working round thousand, so that's there 14,000. I then need to charge depreciation, don't I, to get me to the end of April. So the 30th of April is that 2015. Memory serves me right, we said that was 4 months, wasn't it? So we need 4/12 of the 300. So does that go through there? And 4/12, is that the same as a third? I think it is, isn't it? So that gives me 100. If I do that, that brings me down to 13,900, isn't it? Okay, excellent. If I go through then and revalue the property, I revalue it up to its fair value, was it, of 15.4 million, wasn't it? Okay. So what you've got there now is that you have a surplus, is that of 1.5 million. Okay, 1,500. Okay. Now the key bit there is, as things stand, we're not even looking at IFRS 5, is that the depreciation expense goes to your statement of profit or loss, and the surplus goes there, is it, to your other comprehensive income. So what you have there is that in the statement of profit or loss you have depreciation, is that of 100. If you want, you can put that in brackets as an expense, I don't mind. And then your gain through OCI gives you 1,500, doesn't it? Okay. If you wanted to be really specific, If you're looking at the statement of financial position within the equity section, remember, you would have your other component of equity, and your other component of equity will be there at 1,500, wouldn't it? Okay, representing the gain that we have on this property. So that would go through any other components of equity that you have within the question. Okay. What we now need to do is we now need to get the non-current asset held for sale correct, don't we? So what we've got there, remember, is that we go with, is it the lower of the carrying value and the fair value less cost to sell? Well, the carrying value, we've just recently revalued it up to 15,400, haven't we? The fair value less cost to sell are that 15,400 fair value, and if memory serves me right, the cost to sell are 300, aren't they? It's not rocket science. The lower of the two is always, in this instance, going to be the fair value less cost to sell. So that there is going to be equal to the value of my non-current asset held for sale. So your non-current asset held for sale is it at 15,100. That's the value at the end of April. It will be the value at the end of December as well, because we do not depreciate that asset once it is classified as a non-current asset held for sale. Okay. What we then need to do is we need to think about the journal entry. Okay. You don't have to write out the journal entry, but I'm just trying to give you a deeper understanding of how things work. You need to go through there and credit your property, plant and equipment, don't we? Is that there with the 15,400? I need to debit my non-current asset held for sale at 15,100. Okay. Problem? You bet there is. It doesn't balance, does it? So that debit that we have there is that of 300. That's going to go there to my statement of profit or loss. Technically, that is an impairment in the asset, going immediately to profit or loss, as it is impaired, isn't it? From 15,400 to 15,100. But that impairment will always be equal to the costs to sell. Okay. So the debit to the statement of profit or loss is there as 300. That there is our impairment, and that is there at 300, isn't it? Okay. There we go. Excellent. So that brings together everything that you have there within that question. Okay. What we need to think about now is how is that going to go through and get examined. So from an ACCA P2 perspective, that could potentially be a really tricky computational aspect, couldn't it? Within the group accounts question. So you've got all the information about the group accounts, and then maybe the parent has a non-current asset held for sale. Okay. So if you're looking at the group statement of financial position, you need to work out the value of the non-current asset held for sale. You need to work out the gain that goes into other components of equity, because that becomes part of the parent's other components of equity. And then don't forget as well that the depreciation and the impairment, they are depreciation impairments that are seen within the parent's book. So they need to go through your working five and your group retained earnings, don't they? So you've really got to begin to think about how this can be examined numerically in terms of your group accounts. So, even if it's not group SFP, group profit or loss, and OCI, you've got three numbers that can appear there: depreciation, impairment, and the gain through OCI. Okay. However, from an SFP perspective, you need to work out the figures on the SFP and also the figures that go from profit or loss that feed into retained earnings and other components of equity. So from a group SFP perspective, it does get pretty challenging. However, it would be one of the more difficult aspects if it was to be there in a group statement of financial position question. So have an attempt at it, but do be aware of the level of difficulty. The other way it could get examined could potentially be within question number 2 or question number 3. That wouldn't necessarily focus on the computation. That would more focus upon the discussion aspect. and how you go through and treat that non-current asset held for sale and whether or not it is actually a non-current asset held for sale. You could also go through as well and think about it from an ethical perspective. So maybe a small part of question 1, maybe the accountant is treating it as a non-current asset held for sale so that they do not need to depreciate the asset, when really they have not met the criteria for a non-current asset held for sale, and therefore it should not be classified as a non-current asset held for sale. It should be classified as PPE and therefore should be depreciated. And if we depreciate it, that's an additional expense which reduces profitability, which is why the accountant would not have wanted to leave it in PPE in the first place. Okay, so do just be aware of those several areas that it could crop up for from a P2 perspective. Other than that, I'll go through and see you within the next session. Chris, what I'm going to try and do now is we're going to try and use the same videos. This is going to test you out. And I'm going to just talk about it briefly from a CIMA perspective. Okay. So I think it's a CIMA F1 perspective. Okay. So when I start talking again in a moment, that's when you'll need to edit it and include it, if that makes sense. If it doesn't, give me a shout. So what could we expect, therefore, within our exam? The exam is objective test questions, isn't it? It could go through and have it as one of those select all style questions, whereby the select all style question is to select all of the following, which are criteria of being able to classify a non-current asset held for sale. So keeping away from these numbers there. The other scenario is that it might ask you to calculate any one of those figures that you have on the screen above my shoulder there. Okay, so that would be quite complex, wouldn't it? It might ask you to work out what is the value of the non-current asset held for sale. If that's the case, then you work it out, is it there at 15,100. If it's thinking about non-current assets held for sale, it might ask you to work out what is the impairment on that non-current asset held for sale when it is classified as a non-current asset held for sale. Based upon our example, the impairment would actually be very, 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 very straightforward indeed, because that impairment, when the asset is currently held under the revaluation model, is always going to be the cost to sell. So it'd be nice and easy to get the impairment. It might be a little bit more of a challenge to get the non-current asset held for sale. Okay. But have a work at a couple of the objective test questions. Bear in mind that it's not just going to be a numerical style question. It could be one that involves a select all, or if you like, which of the following statements is incorrect. Okay, so do just think about the exam style question that you could get. Not going to be a huge amount of questions, maybe one or two if you're lucky. Other than that, it shouldn't be too bad. Other than that, I shall then see you in the next session. Goodbye.